just like with the stock market, your goal is to buy low and sell high. So if you do see a crash in the cryptocurrency market, that could be a great time for you to come in and invest and buy in the cryptocurrencies that you believe in. Or if you don't want to be super involved, but you want to have some exposure to cryptocurrency. What's up everybody, I'm Jaspreet Singh, and cryptocurrency is evolving every single day, and every day you have more and more people starting to adopt and understand what cryptocurrency is, even though you still see a lot of volatility up and down with cryptocurrency, which means if you are interested in cryptocurrency or if you want to buy cryptocurrency, you should actually understand what it is, because you have a lot of people buying cryptocurrency without any idea of what they're doing. So what I want to do today is go deep into cryptocurrency so you actually understand how it works and how you can actually build wealth with cryptocurrency. So let's jump right into it.
So why is it so important for you to get rid of your cash, I guess? I mean, why is cash not good in your eyes?
If you look at the US dollar, it's been inflating at least 10% a year for the last decade, from 2010 to 2020. And the S&P 500 index was moving up about 10% a year during that time frame. So if you were holding dollars, if you were holding $100 million, then, and you weren't invested in the S&P index, then you lost $10 million of gains every single year. Or another way to say it is the value of the cash decreased by about 10% a year. And that means over the course of 7 years, you cut your cash balance in half. Okay, what happened in March of 2020 is the inflation rate tripled. If we look at the S&P 500 index over the last 12 months, it's up 30%. I remember I was saying that the money supply expanded at 10% up until about March of 2000. But we all know that the Fed started buying lots of bonds, $120 billion of bonds every month. After that point, the interest rates got pegged at zero. The money supply expanded. And so we started inflating the money supply 3x, 3 times as fast. That means that $100 million in cash is worth $100 million, but $100 million in a stock index is worth $130 million.
Wow.
At a 30% inflation rate, that means that in about 2.5 years, you cut the value of your treasury in half. So what happened to us in March is we realized that we had 500 million, but if you cut it in half every 2.5 years, you realize that you basically burn $450 million over the decade. We're going to lose it all from the shareholder point of view. So the need to find an inflation hedge became much more urgent after March of 2020.
So it's interesting because you talk about how, you mentioned hurdle rate a lot. Could you talk a little bit about that hurdle rate and why Wall Street doesn't like cash particularly?
The price of everything you want to buy is going up, but the inflation rate is not a scalar. It's not a single number. I can measure the inflation on consumer assets if I want, like what's it cost to rent an average house, and what's it cost to buy a Domino's pizza? What's it cost for Netflix? Or what's it cost for canned food or cereal? That's a number. That number is normally not going up as fast. I can measure a different rate, the rate at which really good houses in the Hamptons go up in price, luxury real estate, or an Ivy League education. Or if I go to a doctor not in my healthcare system, but outside of my healthcare network, or a really good dentist that doesn't take my dental insurance, that inflation rate oftentimes is 15 or 20%. I can measure the inflation rate of assets, scarce desirable assets, like stock portfolio. That's 30%. I can measure the inflation rate of a bond. Well, a bond that yields $50,000 in interest a year used to cost $1 million when the interest rate was 5%. But when the interest rates got driven down to 1%, that $1 million bond now cost $5 million.
Wow.
So the cost of an annuity, or the cost of early retirement, if you will, went up by a factor of 5. That's hyperinflation. So inflation is really a question of, it's a function of the person and what they aspire to buy. And if your aspirations are to live in your basement of your parents' home and watch YouTube and travel around by Ubers and watch Netflix and eat Domino's pizza and manufactured food, then the inflation rate is low. If you actually remove from the index the highly volatile food and energy, when we create the PCE index, it removes food and energy. If you remove food and energy and you keep the other manufactured stuff, it's even lower.
And PCE is what the Fed looks at when they measure inflation.
Oftentimes. Yeah. But if you put luxury goods and elite experiences and scarce things, if you put trophy assets or stocks or bonds or commercial real estate, that inflation rate is much higher, right? We can see that the Case-Shiller index is up 27% year over year. Producer price indexes for commodities are up 20, 30, 40%. Stock portfolios up 30%. So you see, if you aspire to stay wealthy or to be wealthy, your inflation rate is not the CPI or the PCE. Your inflation rate is probably more like the return on the S&P 500 index. And so that was 10% a year for a decade, and now it's 30% a year. And so if you wish to protect your family's well-being over a long time, then you're not going to be able to invest in assets that only go up 2% a year or 5% a year. That means that most bonds that yield 3% interest have a negative real yield. Negative 2% against the CPI or negative 3% against the CPI, but that's not really the problem. The problem is they're minus 27% against the S&P, right? So your index ought to be something more like that. If you're the CEO of a publicly traded company, you're expected to keep up with the S&P 500 index. So the inflation rate for a CEO of a public company would be the S&P index, which is 30%. So now, if you're Apple Computer and you have $100 billion in cash and you're generating 1% interest on it, and if the inflation rate's 30%, you're losing $29 billion a year in shareholder value every year. So you see, it becomes a much bigger issue for companies that have large cash positions on their balance sheet. I think Berkshire Hathaway has $150 billion of cash. So $150 billion of cash not invested in the market is a loss of 30% of that, or $37 billion, right? Some large amount of money. And it'll continue year after year. And so that's why this is coming to the forefront right now. You could ignore it. You could ignore it if you thought the inflation rate was only 2%. But when you see all these assets going up much faster than 2%, you realize there's something else going on here. And once you embrace the idea that inflation is a vector, it's not a scalar. A vector meaning there's a different inflation rate for every product you want to buy in every jurisdiction where you might be, and it's changing all the time, right? The way you describe fluid dynamics or aerodynamics is vector calculus. You would never try to describe those things with arithmetic. You couldn't model. You can't model fluid flow around an airfoil with arithmetic. It doesn't work. So once you understand that inflation is a vector, then you start to realize that conventional remedies won't work. You can't save your money in a savings account. You can't hold simple bonds. You're going to have to find some other inflation hedge, and that leads you to look for scarce, desirable assets. And the scarcest, most desirable asset in the universe is Bitcoin, because Bitcoin is digital property. It is all the benefits of gold, all the benefits of property, all the benefits of money without inflation, without friction, indestructible, immortal. move at the speed of light, programmable, and everybody wants it on Earth, and you can send it to anybody on Earth. So that makes it kind of the ideal solution in an inflationary environment. I guess one more point that I should make is inflation's bad in the US. It's much worse everywhere else in the world. Whereas the United States dollar might be losing 30% of its purchasing power a year in the last 12 months. But in Argentina, they're losing 60 to 70% of their purchasing power a year.
Wow.
And in Zimbabwe, in Venezuela, and other weaker regimes, they're losing 90% and 95%. So lots of people live in economies where the currency is collapsing. 30% is kind of a collapse, but 90% is that's what happened in Lebanon this year. It's complete collapse. So if your currency is collapsing and you don't have ready access to buy the NASDAQ stock index or the S&P index, then Bitcoin is your solution, because you can put Bitcoin on any mobile phone. So all you got to do is have a mobile phone, and then you can protect your wealth from debasement, and you can conserve your property.
But why is that better than something like real estate?
If you owned a ranch in Zimbabwe, and the regime changes hands, they might take it from you. If you own property in Argentina, when the currency collapses, you have two problems. One, well, many problems. You can't take the property out of Argentina, right? If all of your money is invested in land, you can't move it. So when you have to leave the country, and you might flee the country, or you just might emigrate because maybe you can't get a job there. Maybe you can get a job in New York, but you can't get a job in South America. So you want to move to New York for your job, but you can't take your property with you. That's a problem. The second problem is it gets taxed. If I had $100,000 of property, even in Florida, let's say, there's a 2% property tax a year, and there's a maintenance cost. So the maintenance cost is insurance. You got to paint it. Maybe there's a water leak. There's all sorts of things to maintain a building, maintain a house, even to maintain land. There's a maintenance cost in the form of property tax. That maintenance cost can get to 2 to 4% of the value of the asset. So that means that if you divide 4% into 72, in 18 years, you're going to lose your property. Right? If the maintenance cost is 4%, then you spend the entire value of the asset in 18 years to pay the property tax and the maintenance. But it's worse than that, because normally if there's inflation, the value of your property will be assessed up by the tax collector. So if I print 10% more money a year and I raise the value of your property by 10%, I raise your property taxes by 10%. So you started out with $100,000 of property. In 20 years, when your daughter or your son inherits the property, it's valued at $10 million, and there's a $400,000 tax on it, or $200,000 tax on it. And they're paying more in tax than you paid to buy the property. So have you heard the story of all the families that lost their farm or lost their family home because they couldn't afford to pay the property taxes on it? It's a very common happenstance in the last 100 years. So if you wish to store intergenerational wealth and give it to your children and your children's children and your children's children, property doesn't work unless it's rental property. If it's commercial property and you can generate more rent on it than the tax and the insurance and the maintenance, then maybe you can maintain that. But you can't just maintain a low performing, like a not very profitable farm or a home. It won't work. And ultimately, if you have that property in the wrong place, right? If you had that property in Nazi Germany in 1935, you lost it all, right? If you have that property when the regime changes, you may lose it. So property doesn't turn out to be a good way to store your family's wealth over 100 years. The maintenance cost is too high. It's subject to inflation. It's subject to confiscation, and it's subject to taxation. And those are three problems. And those are the problems. They're the problems that cause most families and most corporations to go bankrupt. Either they're taxed out of existence, or what you own is confiscated from you because you're the wrong religion or the wrong color or the wrong ethnic group or the wrong place at the wrong time. They are seized by eminent domain, or ultimately it's just taxed.
But I think
that's another way of seizing it.
What people will say is, you look at real estate, it's something I can see, I can feel it, I can touch it. And I'm not going to see the value of my property drop by 30% in a week or up and down, that versus Bitcoin. I mean, you could see crashes and booms multiple times in a year.
If you have $1 million of gold stacked in front of you, you can see it, but so can criminals, and they'll take it from you. And if they don't, the government will take it from you. And every single country seized the gold of their citizens, or the bank stole the gold of their citizens in the last 100 years because it's tangible. If you had $1 million in property, you can see it, but so can the tax collectors. And when they need to raise money in your city to pay for schools, they're going to tax your property. And when the government wants to fight a war or they want to do something, they're going to tax your property and you're going to lose it. If you have $1 million of Bitcoin, they can't see it. It's less likely you'll get robbed by a criminal. It's less likely you'll get taxed. If the city that you live in has a municipal tax on your property, you can move your Bitcoin to some other city. If the state taxes it, you can move it to a different state. If the country taxes it, you can move it to a different country. Ultimately, you can find someone to buy your property. If it's digital property, if it's analog property, if you have the most beautiful thing in the city where you live, and I don't want to live there, I don't want it, right? If I have a piece of property in Istanbul, people that want to live in Istanbul may buy it, and banks that bank property may lend you money against it. And they'll lend you money in the currency of the city. So you can maybe get a loan in Turkish lira from a Turkish bank, and maybe you can sell it to another Turkish person. But you see, that's a very small part of the world. Only 0.1% of the world has money in Turkish lira that wants your Turkish property. Wouldn't it be much better if you had a digital hotel that you could move to any city in the world, and then you could borrow money in any currency from any bank, and you could sell it to anybody? And that makes it universally desirable. So it's counterintuitive. Your first response is, yeah, I want the 20th century solution. I want the gold because I can touch it. I want the house because I can live in it. Look, if you're going to live in the house, by all means, own the house. If you're going to own property for your children, get your dream home, buy the car to drive in. If you love art for your wall, buy that and put it on the wall, put a sculpture in your backyard, right? It's okay to buy property that you or your family can touch and feel and you love and you need. My point would be, if you're going to buy $1 million warehouse in Kansas, or you're thinking about buying a building in Singapore, you might be better off to buy the Bitcoin, because the stuff in Kansas has a much smaller group of people that want to finance it or want to buy it. And the same is true with the building in Singapore. And let's come back to the theory of property. Why is property valuable? If I own a building in Las Vegas, if I can borrow against it or mortgage it, that's valuable. If I can sell it, that's valuable. If I can develop it, if I can add 20 more floors on top of a 10-floor building, that's valuable. If I can lease it or rent it out to a casino or a bank, that makes it more valuable. If I can put a lien on it, if I sell the air rights above my building for $10 million to the building next to me so they can build their skyscraper, that's valuable. So when I own the property, I have valuable rights. If I actually owned a share in a REIT, if I was a limited partner in a real estate investment trust, I would own a security, but I wouldn't have the rights of property ownership. You can't mortgage a share of stock, and you can't lien it, and you can't You can't force the building to be developed, and you can't rent it, take it away from one deadbeat renter and give it to a better, higher value client. So your property rights are much weaker in a security than they are in unfettered property. So yeah, I want to own the building, but you got to be a rich person to own a building, and you need a team of property development managers to manage the building. And here's the big idea. That's analog property. Digital property could be developed in many more ways. Any computer programmer can develop an application to improve your digital property. So for example, if that 1,000-room hotel in Vegas becomes a digital hotel, the first thing I do is I can move it from Vegas to New York, and I can move from New York to Japan during the Olympics. So now I can find the city that will pay me the highest price for my room nights. Okay, that's good. Well, if the taxes go up in Japan, I can move to Singapore. That's better. So you see, my digital property is less taxed, and it generates a higher rental income. But here's the other thing. The frequency of the property increases. You can maybe rent a hotel room for a night in Vegas, but what if I could rent it for an hour? What if I rented, instead of 1,000 room nights a day, I rented 24,000 room hours a day? And what if I could split the room hours and rent them between Japan and Tokyo and Singapore and London and Paris and New York and Vegas? Now I've decomposed my hotel. Now, what if I decompose my hotel down to room minutes? And what if I basically sold out the room minutes in a million different places and I recomposed it? Now that digital property is starting to look less expensive to maintain, less likely to be confiscated, higher yielding, generating a higher average price. And I'm going to have, I'm going to go from 100% occupancy, where I sell 1,000 room nights a night, 365 days a year. And I'm going to go to 10,000% occupancy, because I'm going to be selling out room minutes at a triple average rate to the highest bidder. And so at some point, your digital property becomes almost digital energy. It's like moving very fast. It's high velocity capital. And what's the price you pay? Well, the price you pay is you can't see the energy. The benefit you get is 1,000 times as much energy. Does that remind you of something in the real world? Like electricity? Like think about if I said to you, I'm going to deliver 400 horsepower of energy to your kitchen or to your carriage. Okay, would you rather have the 400 horses in your kitchen or just the electric motor? You see the silliness of it all, right? Yeah. If I put 400 horses in your house, they would crap over everything. And I couldn't fit them in your house, and they'd probably kick you in the face. And you have to feed them. So it's just not, if I put 400 horses in your boat, they'd topple the boat over. But if you look at all those boats, they have 350 horsepower motors, right? You're using condensed energy, either in liquid form, which we call diesel, oil. That's what John D. Rockefeller gave us, liquid energy. Or you're putting it in electric motor form like Tesla, and we can thank Tesla and Thomas Edison. They gave us, electrical energy. And that concentrated energy is something, you can't see it. It can kill you, by the way, right? It'll shock you to death. But try to imagine New York City without concentrated electrical energy. And by the way, try to imagine it without concentrated metallic energy. What's another word for concentrated metallic energy? Steel. Steel is concentrated metallic energy. You want to build a skyscraper? You need to actually pour a huge amount of energy into a steel mill, create the metal. You can build a skyscraper, and you need the electricity to run the elevators. You turn off the electricity, everybody's going to die. You take away the steel, everything collapses. So why Bitcoin? because Bitcoin is concentrated energy in digital form. And what's the problem? Oh, yeah, it's new, it's different, it's scary. I can't see it, I can't touch it, I can't smell it. Can you see, touch, or smell electricity? No. Is it real? Yeah. Right. And so if I want to build something to last 1,000 years, I need to build it on a foundation of monetary energy. If you want a family endowment, if you want a school, a university, a city, a country, a company, you need a balance sheet. And if you build your balance sheet on an asset that's crumbling 10% a year, you're only going to last 10 or 20 years. If it's crumbling 20% a year, you won't last 36 months. If it's crumbling 3% a year, you might last 50 or 100 years. You want to last forever? You need something indestructible. Bitcoin is immortal, indestructible, monetary energy.
We're going to jump back into the video in just a second, but before we do, I want to tell you very briefly about Market Insiders, our investing coaching program. If you've been thinking about investing your money into the stock market, the real estate market, or the cryptocurrency market, and you're looking for some extra guidance, this is what Market Insiders was created for. It is not a class. Market Insiders is a coaching program where every week you get access to a real estate class, a stock market class, and a cryptocurrency class, which is live, led by one of our investing coaches. Our investing coaches are not investing gurus. These are real investors who have been investing for years, they've gotten great returns, and they have the money behind them. I'm talking about hundreds of thousands, if not millions of dollars invested themselves, and they're teaching from their experiences and their failures. That way you can learn from them every single week. Now, the cool thing about Market Insiders is you get access to more than just the weekly coaching. You get the weekly investing coaching, you get access to all of our previous recordings, you get access to our investing classes, and you also get access to our private Discord community. That way you can chat with other investors. So if you're trying to get started as an investor in the stock market, the real estate market, or the cryptocurrency market, or you're trying to figure out how you can be a better investor and get better returns, then Market Insiders is for you. That way you can get that kind of handheld coaching guidance, because now it's not just a class where you're going to be left hopeless trying to figure it out for yourself. Every week you're going to get access to stock market, real estate, and cryptocurrency coaching sessions, and it's all included. Now, if you're skeptical about all this, I get it. That's why you don't have to pay a penny today. You can try out Market Insiders for free with our 10-day trial. During the 10-day trial, you'll get access to everything. You can join the coaching calls, you can watch the previous recordings, you can attend the classes, you can go through the Discord and chat in there, you can ask your questions, and then you can see if it's right for you. If during those 10 days you realize, I hate this sucks, well, then you can quit and it's not gonna cost you a penny. But if you go through it and you say, wow, this is amazing, I'm blown away by the education, well, then you can stay. And if you decide to stay, it's not gonna cost you an arm and a leg. Market Insiders cost less than the cost of going out to eat. It costs less than $30 a month. So if you wanna try it out, I'll put the link to how you can learn more and join Market Insiders with a free trial in the description below. It was very important to me that you feel comfortable investing in your financial education. That's why I wanted to make sure that you had nothing to lose and everything to gain, which is why if you wanna learn more, you can get started with a free trial. That way you don't have to commit to spending a penny until you know if it's right for you or not. So if you want to learn more and try out Market Insiders and see if it's right for you, I'll put the link to where you can get started with your free trial in the description below. Cryptocurrency has been growing in popularity faster than ever, which is good for people who understand cryptocurrency. But for somebody who's just getting started with cryptocurrency and trying to understand it, it can be very overwhelming. First, you have to wrap your head around the idea of what cryptocurrency is. Then you start learning about blockchain. Then you start learning about altcoins. And then you start hearing about things like cryptocurrency staking and then DeFi, decentralized finance. And it can become a lot of information very quickly, which can scare people and kind of push people away from trying to do anything because it's just a whole bunch of information. It's information overload. Cryptocurrency is a very unique asset class where there are multiple ways to make money off of the same currency, which is why in this video, I want to go over 5 different ways that you can make money with cryptocurrency. I'm going to talk about 1, buying and holding cryptocurrency. I'm going to talk about how you can make money from the new age of saving cryptocurrency and how you can earn interest on beyond that, I'm going to talk about how you can make money from DeFi. I'm going to talk about how you can make money from staking. If you've heard of these terms before and they made no sense, I'm going to try to break it down so it makes sense after this video. And then I'm going to talk about some of the tax loopholes that you can use in cryptocurrency. And you definitely want to pay attention to this because these might be going away. So make sure you watch this video until the end. And before we jump into this, I do have to give you a little bit of a disclaimer because investing has risks and cryptocurrency has even more risks than that because it's a volatile asset class. So make sure you do your own research and never blindly listen to a random guy on YouTube. So let's start by talking about number one, holding cryptocurrency. HODL is a term that a lot of people use in the cryptocurrency space. Started off as a typo of the word hold, but the whole idea here is you want to buy and hold cryptocurrencies for the long term. This concept is the most relatable because you have the same thing in the stock market where you want to buy a share of your favorite company, and then if this company grows, your share is going to be worth more, and then you'll be able to sell it for a much higher price later on, assuming that this company becomes more valuable. It's the same thing here in cryptocurrency, except you do have some differences. The goal of buying and holding cryptocurrency is, for one, obviously that your cryptocurrency becomes more valuable and that your cryptocurrency becomes more widely used. That way now either you can sell your cryptocurrency back to dollars and now you have way more dollars than you did before, or it's more widely used so now you can use this cryptocurrency to make transactions with. This is where you're going to have to do a little bit of research and understand what your goals are, because cryptocurrency started as the idea of just being this digital currency, but it's grown way past that. Bitcoin started with the idea of being a decentralized worldwide digital currency, which means it's a money that can cross borders, and one Bitcoin in America is the same as one Bitcoin in Japan, and it's the same as one Bitcoin in India. So now you can transfer money across the world. You don't got to worry about conversion rates, and it's very easy to pay people because it's all digital. Well, now cryptocurrency has really evolved way past just a currency because it's become a whole technology of its own. This is called blockchain. You might have heard of or seen the hype behind NFTs, non-fungible tokens. Well, an NFT is essentially digital art. You can memorialize something on the internet and then sell it. Now, whether you love the idea or hate the idea, that's not what I'm talking about. What an NFT is, it is this digital art, but it's built on top of the Ethereum blockchain. So now when you're investing in Ethereum, you're not just investing in a currency, you're investing in the blockchain. You're investing in the technology behind it. So now when more NFTs are built, or when more things are built on top of the Ethereum blockchain, this essentially pulls Ethereum out of the network, and now you still own a piece of the Ethereum. So as more and more systems and technologies are built on top of the Ethereum blockchain, these essentially pull some of the Ethereum out of the network, which limit the supply of Ethereum, which would in turn, in theory, make Ethereum more valuable as long as it maintains its demand. So when you're trying to find a cryptocurrency to buy or invest in, the two things that you have to pay attention to are the uses of that cryptocurrency and then the network. And let's talk a little bit deeper about both of these things. The uses are what the cryptocurrency allow you to do. Like Ethereum allows you to build NFTs on top of it. And Ethereum also allows you to build decentralized exchanges. I'm going to talk a little bit more about that and what that is when I get into DeFi's. But the whole idea behind Ethereum is it is a base technology which allows you to build more things on top of that. You can compare that to something like Bitcoin, where the use was for it to be a digital currency that you can use to pay people with. This is why you have so many different cryptocurrencies, because a lot of these cryptocurrencies work to excel at one thing a little bit better. For example, to send Bitcoin or to pay somebody with Bitcoin, it's expensive, it can take a long time, and there's a limited number of transactions that you can do in 1 minute or in 1 hour with Bitcoin. That's why certain cryptocurrencies are working to allow you to make transactions faster and easier and cheaper. And with Ethereum, it can be expensive to transfer Ethereum, and they can use a lot of gas in order to do that, versus you can use other cryptocurrencies which allow you to build certain technologies a little bit cheaper and a little bit easier. And then on the flip side, you want to look at the network. The network is really just the amount of people that are using the cryptocurrency. For example, if I own Bitcoin and I start to tell you and everybody else to start buying Bitcoin, this in turn benefits me, because if everybody else starts to buy Bitcoin, well, now there's going to be more buyers of Bitcoin, and that's going to make the valuation of Bitcoin more, because now there's more people buying. There's more demand of Bitcoin, while there's still a limited supply of cryptocurrencies like Bitcoin. That's one of the reasons why a lot of people have been adopting and moving towards cryptocurrencies, because the whole idea behind cryptocurrency is it is decentralized as opposed to our dollars, which are centralized. See, our dollars are controlled by the United States government and the Federal Reserve Bank, which can control and increase or decrease our monetary supply. And so what these central authorities and the central bank does does can affect how much money that I have in my wallet. Although my bank account balance might not change, the amount of buying power that my $1,000 has will change. Like if you look back over the last few decades, the price of Coca-Cola, the drink, has gone up 20x. Now, the value that you're getting from your Coca-Cola has not gone up 20x. It's just that the value of your dollar has gone down significantly, and so now you need more dollars to buy that same can of Coke. And so the whole idea here behind cryptocurrency is you are able to limit the supply of cryptocurrency, which allows you to limit the manipulation of your money, in this case cryptocurrency, by somebody else. Plus, it's decentralized, meaning it's not controlled by one central agency or one central government. Like the Federal Reserve Bank does not control cryptocurrency. Just like that, the United States government does not control your cryptocurrency or your Bitcoin. Bitcoin, for example, is controlled by its users. So you have computers and networks around the world which control Bitcoin, so it's not controlled by one agency, which makes it less prone to this type of manipulation. So the first way that you can make money with cryptocurrency is just by buying and holding. Now, just like you have with the stock market and the real estate market, you have investors and then you have traders. Traders can make more money in the short term, but it comes with more risk. The more proven route to succeeding, whether it's the stock market, the real estate market, or in this case, even the cryptocurrency market, is by buying and holding for the long term. That can be a little bit harder to do, especially in cryptocurrency compared to the stock market, because the cryptocurrency market is way more volatile than the stock market. You see way more big swings up and down, which can get people excited and greedy and want to buy in when things are going up because you have the fear of missing out, FOMO, and then when things start coming down, you can get scared and panic and sell, which can lead to crashes. I mean, it is possible that we could see another 2001 style .com type crash in the cryptocurrency market, but you have to understand that there's more value behind cryptocurrency than just a digital number. I mean, it is a real technology which will probably, in my opinion, be around for the future. And so you have to understand that if you are investing in cryptocurrency, you are going to see wild swings up and down. You do not want to be following the hype. You do not want to be chasing, but you have to be smart and understand what your goals are. Just like with the stock market, your goal is to buy low and sell high. So if you do see a crash in the cryptocurrency market, that could be a great time for you to come in and invest and buy in the cryptocurrencies that you believe in. Or if you don't want to be super involved, but you want to have some exposure to cryptocurrency, you can just dollar cost average your way into some cryptocurrencies. So you can find some cryptocurrencies that you like and find a platform which will allow you to create repeating buys, whether it's daily, weekly, monthly, whatever you want to do, and you can just dollar cost average your way in. That way you can get some exposure to cryptocurrency. Just remember, again, you are going to see a lot in volatility. It's not going to be uncommon for you to see days or weeks where you see 30% rises, and then the next week you see 30% crashes. This happens in the cryptocurrency market, so you have to be aware and you have to be smart, and you don't want to be buying and selling on emotion. You want to be educated and understand what the uses are. Yes, you can see a massive cryptocurrency crash, but you got to understand what your goals are, and you got to understand what it is that you're buying, because if you actually believe in the technology and if you believe in the usage of this cryptocurrency in the future, then those crashes are an opportunity for you to buy more. If you don't believe in cryptocurrency and if you think that people are not going to be moving towards this type of technology, well then don't buy cryptocurrency. The second way that you can make money in your cryptocurrency allows you to earn money without having to sell your cryptocurrency, because now you're going to earn interest on your cryptocurrency, but kind of like putting your cryptocurrency into a savings account. Now I'll put it in quotes because it's not technically a savings account. These are not banks that you're putting your money in, but that's the easiest way for me to explain what it is, but that's not actually what it is. So let me explain. There used to be a time where saving your money was the smart thing to do, because if you took your money, your cash, and you put it in your savings account, your bank would pay you somewhere between 8 to 10% a year on your savings. It was risk-free, and the bank would then turn around and they would lend your money out, but they would pay you 8 to 10% a year on your savings, which meant that your savings would actually grow. Nowadays, your bank's savings account pays you nothing, or at least next to nothing. And so if you put $100,000 in the bank, after a year, you might get a few pennies. Well, technically, I might get a few dollars, but you get the idea. In cryptocurrency, there are centralized exchanges which allow you to kind of save your money. They park your money into these accounts, and then they will lend your money out, and in exchange, you will get interest. But the interesting thing is you can pull your money out, you can pull your cryptocurrency out whenever you want. So let's assume that you go out and you buy Bitcoin or Ethereum. What you don't want to do is just keep your Bitcoin or Ethereum on the exchange that you bought it on. So let's assume you bought it on Coinbase. You don't want to just keep your Bitcoin and Ethereum on Coinbase, because that it's prone to potentially being hacked or stolen. So you want to put your money into a wallet. One thing that you can do is you can put your money, your cryptocurrency, on a cold wallet. A cold wallet is a USB drive, so you're going to take your cryptocurrency that's on the internet, and then you're going to take it off the internet and put it in a USB drive. Another thing that you can do is you can put it into a hot wallet. A hot wallet is a digital wallet, and so now your money is safe in this digital hot wallet, and it has a whole bunch of protections around it which make it hard for somebody to come in and hack it and take your money away. The third option is you can put your money into one of these type of accounts where now your account is going to earn you interest on your cryptocurrency. So if you have some Bitcoin or Ethereum, you can put your money in one of these exchanges, and then these exchanges will then work to lend out your cryptocurrency, and in return they're going to pay you interest for keeping your Bitcoin or Ethereum on one of these exchanges. Now, the good part is you can pull your money out whenever you want. The interest rate that you get on your cryptocurrency is going to depend on which exchange that you go through, because some exchanges are going to lend their money out, their cryptocurrency out, to more risky borrowers, and other exchanges are going to lend their cryptocurrency out to more stable and proven borrowers. What you'll see is that a lot of times your interest rates on these accounts, I'm not allowed to call them bank accounts because that'll get me into legal trouble, but your interest rates on these accounts will pay you much higher interest rates than the interest rates you get at your traditional bank account where you just keep your cash. And at this point you might be thinking, wow, I wish there was a safer way for me to earn these type of interest rates on my money where I didn't have to worry about the volatility of Bitcoin or Ethereum, because you see a lot of ups and downs in these type of cryptocurrencies. If only there was a way for me to earn this higher interest rate on a safer, kind of more stable cryptocurrency. Well, there is, thanks to something called stable coins, and stable coins are a kind of cryptocurrency which are tied to the value of a fiat currency, in this case our dollars. Now, without getting overly complicated, you have certain stable coins which are pegged to the value of the dollar, which means that they own or they hold on to US dollars based on how many people buy their stable coin. So in theory, if somebody goes out and buys $100 worth of a stable coin, this stable coin will then go out and gather another 100 US dollars. That way the stable coin's price don't change. There are other stable coins which don't hold on to US dollars. Instead, they're algorithmically pegged to the value of the US dollar. And there are other stable coins which hold on to cryptocurrency which try to mimic the value of the dollar. So if the dollar goes up or down, they'll sell or buy other cryptocurrencies to make up for that value. So now what you can do is you can go to one of these financial service accounts and buy up a stable coin like Tether, USDT, or USDC, which is a stable coin created by Coinbase, and then you have USDG, which is a stable coin created by Gemini. So these companies create these stable coins, you can convert your dollars to these stable coins, and then these accounts will pay you interest on these stable coins. And the interesting thing is, at the time I'm recording this video, you can earn between 7 and 8% a year. And the interesting thing is, at the time I'm recording this video, you can earn more than 8% a year in interest on your stable coins, and you can sell your stable coins and convert them back to dollars essentially whenever you want. So to put that in perspective, let's say you have $10,000. If you put this in the bank, you might get 0.01% a year in interest. This is what a lot of banks are paying out right now, which means after 1 year, you will earn a whole $1. Nice. Now, if you take these $10,000 and you move it to a stable coin, you will be able to buy 10,000 stable coins that are valued at $1 each. Now, the stable coins might pay out, let's just say 8% a year in interest, which is not uncommon. Then you will be able to earn $800 in 1 year on these stable coins, and then you have the option to pull out the 10,000 or the 10,800 whenever you want. Remember, these stable coins are pegged by the value of $1, so they don't really change. They stay at $1, and you can buy one stable coin with $1. Now, at this point, if you're like me, you're probably wondering, okay, Jasprit, that sounds cool, but what are the risks? Because that's exactly what I was wondering before I moved a big chunk of my savings here to earn this interest on my stable coins. The first risk is that these financial service institutions are not FDIC insured because they're not banks. And so if you remember back before the Great Depression, there was no FDIC insurance. And so when there was a run on the banks, you saw some banks collapse and people were not able to access their savings. That's why when you're looking for a company to pay you interest, you want to make sure that you have a reputable company that's well funded. That way, in case things go wrong, they have reserves to help pay you out. Second, you want to make sure that your cryptocurrency, in this case, is safe on this financial service institution's platform. So what you want to make sure is that this financial service institution that you're using is taking your cryptocurrency and they're putting it in cold storage. That means you give them your cryptocurrency, that way you can earn interest on it, and while it's sitting there, they will take it and put it on USB drives, that way your cryptocurrency is safe, and that they insure your cryptocurrency, that way it is actually protected, and they have the right firewalls protocols to make sure that your cryptocurrency is protected and safe. And third, there's a chance that your cryptocurrency or the stablecoin that you're buying into goes bust. For example, USDT is a stablecoin owned by Tether, USDC is a stablecoin owned by Coinbase, and then GUSD is a stablecoin owned and created by Gemini. All three of these stablecoins are created by three different companies, and the risk here is what happens if Coinbase goes bankrupt? If that happens, then you could lose the value of your stablecoin and it might no longer be pegged to the value of a dollar. I mean, it could create a lot of problems. The way you can kind of work around that is one, research which stablecoins you're investing your money into, see if they're regulated, see if they're backed, see what they're doing to protect their stablecoins, and second, you can also diversify across different stablecoins. So again, just do your research. So is earning this type of interest on your stablecoins completely risk-free? No, it's not, but you can mitigate a lot of your risk by learning and by not getting greedy, because you're going to have some exchanges that are going to offer you way higher returns, and they're going out making riskier loans, and then they're going out and they're cutting corners on your protection. So yeah, you might get a better return today, but there's a higher chance that you could lose your money. Again, it just comes down to doing your own research and seeing what's right for you. I have moved a big chunk of my savings into stablecoins, which are paying me this 8% a year in interest, and I'm waiting to use this money to invest it into other investments or real estate or somewhere where I really want to park my money, but in the meantime, I'm putting it here, and I'm using a platform called BlockFi, who is also a sponsor for Minority Mindset. The way BlockFi works is exactly what I just talked about. You can buy stablecoins, or you can buy Bitcoin, or you can buy Ethereum, or a number of other cryptocurrencies, and then you can earn interest on your cryptocurrencies directly through BlockFi. The reason why I like BlockFi is because they're lending the cryptocurrency out to top-tier institutions, so it's a little bit safer in that regard. You're not going to get as high of an interest rate with BlockFi as you would on some other platforms, but your money is a little bit safer because now these institutions are backed by a lot of dollars. The third way that you can make money on your cryptocurrency right now is through a concept called DeFi. Now, DeFi gets a little bit more advanced. It stands for Decentralized Finance, and I'm going to try to break it down in the simplest way possible. So if we start at a very high level, DeFi is really just the entire financial services industry without centralized organizations. With DeFi, everything is done peer-to-peer. So let's assume that you want to get a ride to the airport. Instead of going to Uber to find a driver, you could just connect directly with the driver. Or if you want to get insurance, instead of getting insurance through an insurance agency, you can go directly to people who will give you insurance. Now, this concept of decentralization is very popular in cryptocurrency because people like the idea of being anonymous. They don't want to be monitored or controlled by the government, and so they like the idea of their cryptocurrency being decentralized. So if you go onto Coinbase, for example, and you convert your Bitcoin to Ethereum, or if you buy Bitcoin, you're doing this on a centralized platform because this is controlled and run by Coinbase. Coinbase is one central company which runs the platform. So now you go onto Coinbase and you make a transaction, Coinbase knows what you did, and they can even report this to the SEC or the government if they wanted to, or if the government forced them to. So Coinbase is an example of a centralized exchange, but you also have decentralized exchanges which are built on top of the Ethereum platform. These decentralized exchanges work kind of like Coinbase, except now everything is anonymous. It's not run by one organization, it's run by a whole bunch of different computers all around the world, and so everything is anonymous. Now you can go to these decentralized exchanges. One popular example is an exchange called Uniswap. You can go here and now you can exchange one cryptocurrency for the other. So you transfer your cryptocurrency here, you transfer it to the other, and it's all completely anonymous. So that's what DeFi is. DeFi is the financial industry that is decentralized, not controlled by a single entity. How do you make money through DeFi? Well, you can go to certain DeFi platforms and lock up your cryptocurrency there, and then once your cryptocurrency is locked up, this DeFi platform will then use this cryptocurrency. Maybe they'll lend it out, or they use it for liquidity. There's a lot of different things that they can use it for, but in exchange, they will pay you with interest. A couple popular examples of these type of DeFi platforms are Compound and Aave, AAVE. Again, locking your cryptocurrency up in a DeFi platform has its own fair share of risks, and if you're just starting off, this might be a little bit too advanced, but this is what cryptocurrency enthusiasts love, because cryptocurrency was built on the idea of being decentralized, and a lot of it is having to do with being anonymous. So cryptocurrency enthusiasts love the whole DeFi industry, but if you're just getting started, this might be a little bit overwhelming. The fourth way that you can make money with your cryptocurrency is by staking your cryptocurrency. You might have heard of a concept called Bitcoin mining, where people set up these advanced computers that solve math problems, and when you do that correctly, you get rewarded with more Bitcoin because now you are helping to produce more Bitcoin. Well, for other cryptocurrencies like Ethereum and Cardano and Polkadot, you don't have mining, instead you have staking. And the way it works is now you are going to lock up your cryptocurrency, and then your cryptocurrency will be used to help maintain that network, and in return you will get paid with more of that cryptocurrency. The tricky thing here is you don't always know how long your cryptocurrency is going to be locked up for, and you don't always know what kind of interest that you're going to get. But if you're one of those people that owns a cryptocurrency and you know you want to own it for a long time, you could either just keep it there in your wallet, or you can stake it and then earn some interest on it because you're going to be holding on to it anyways. Initially, if you wanted to stake a cryptocurrency, it was pretty advanced and pretty technical because you had to have a designated computer set up to do that. Now you have exchanges and wallets that do it for you, which make it a whole lot easier. A couple examples of exchanges that allow you to stake your cryptocurrency are Kraken and Binance, and now even Coinbase is getting on it. And the fifth way that you can make money through cryptocurrency are through tax loopholes. And before we dive into this, I do gotta let you know that although I am a licensed attorney, I am not your attorney. So if you have specific tax questions or legal questions, you need to talk to a professional in your area. So now, if you go onto the stock market right now, and let's assume that you bought a stock and you paid $10,000 for it, and then the value of the stock drops down all the way to $5,000, you were at a loss of $5,000, but you don't actually realize that loss until you sell. But now let's assume also, for the sake of this example, that you also have another investment that you made where you had already sold it and you have a profit of $20,000. Well, now you're going to have to pay taxes on this $20,000 worth of profit. But what you could do is, if you sold this, then you're going to have a loss of $5,000. And then you could tell the IRS, hey, I made $20,000 here, but I lost $5,000 here. So technically, I only have made $15,000 net. So now you're only going to pay taxes on $15,000 because you made 20, but you lost 5. But now let's dive a little bit deeper, because what if this is an investment that you believe in and that you want to own forever? What if you just sold the stock, you took this $5,000 loss, you only paid taxes on $15,000, and then immediately after you made this sale, you buy the stock right back up? Now you got the best of both worlds. You get this tax loss, that way you get to pay less money in taxes, and then you still own the stock. So you really didn't lose anything. But the IRS says that you're not allowed to do that in the stock market due to something called the wash sale rule, which says that if you're going to sell your stock at a loss to get these type of tax benefits, well, then you're not allowed to buy the stock back up for at least 30 days. So that's how it works in the stock market, but that's not how it works in the cryptocurrency market. Because right now, there's a little loophole which allows you to do this exact same thing in the cryptocurrency market, but you don't got to worry about the wash sale rule. So at the time of me recording this video, this is legal in the cryptocurrency market. You can own Bitcoin and you can see a loss in your Bitcoin or Ethereum, and then you can sell it, buy it right back up. And if you have a loss, you can use that loss to offset some of your other gains and maybe even some of your income. There are certain ways for you to sell your short-term losses. And now if you have these short-term losses, you can offset these losses against your own income, and then you can buy those losses right back up. So if you're losing money in Bitcoin or Ethereum, you can just sell it, take these losses, deduct it against your taxes, and then buy right back up. So you own the asset, you got the tax deduction, and you got the best of both worlds. Now the interesting thing here is it looks like the IRS might be cracking down on this soon. CNBC recently put out an article that says that it looks like the IRS is trying to crack down on this loophole. But as of now, it's still around. So you can talk to your accountant and see how you could potentially use this to pay less money in taxes legally. People have always been really hesitant and reluctant to change. This has been going on for centuries. I mean, even back in the 19th century, when textile mills first started coming out, all the skilled artisans and the textile workers became very angry because their jobs were being taken away by machines. And so these textile workers started banding together. They were known as Luddites, and they went out and they would go and destroy textile mills because textile mills were taking away the jobs from the textile workers. When the internet came out, everybody thought that there was no way that people would spend their time staring at a computer screen, yet look at where we are now. When ride-sharing services like Uber and Lyft started to become very popular, you saw massive protests by taxi workers because they felt that their jobs were being taken away by this new technology. And now we're at a point where technology is changing the way that we do money. Technology has been changing the way we do money for a while now. I mean, before credit cards and debit cards, money was exchanged through cash. And so when you went to the store, you would buy things with cash or a check. and then came debit cards and credit cards, which allowed you not to have physical cash in your pocket, but you could just carry this piece of plastic. And now this plastic was connected to your bank account, and then you can go spend money through this debit card or credit card. And it was almost like just these digits that were transferring where you never had to deal with the cash. It was just numbers on a screen. But now this future of money is transitioning even more with all the development going on in blockchain and cryptocurrency. The reason technology is going to change the future of our money is because it is going to make the transfer of money safer, and it's going to make it easier. I mean, if you really think about it, using cash or a card like a credit card or debit card, or signing a piece of paper like a check, is a very risky way to transfer money, because these things are easily copied, they're easily hacked. If you have $1,000 in your wallet and you accidentally wash your jeans, well, there goes $1,000. Or if somebody robs you, your $1,000 are gone. If you're using a card, it's very easy for a hacker to find your card number. It's very easy for them to now use this card somewhere else in the world and buy things from your money. Now, I know cards have protection, like fraud protection, so if somebody does use your money, you can get this money back, but the risk is still there because they can access your card, they can use readers when you insert your card into a chip. That way they can steal your number, that way they can use your money to buy other things. And signing a piece of paper to transfer money is one of the riskiest things you can do because it's so easy to forge a signature. And so when we're talking about wiring money or writing a check, and the signature is the only source of verification, that is one of the worst things that you can do to verify if this person actually wants to send this money. This is where technology comes into play, because technology has many layers of security which go way beyond just your signature. For example, if you use Apple Pay, in order for you to use it, it looks at your Face ID or your fingerprint. And so now for somebody to use your money through Apple Pay or through this technology, then they're going to either have to have you with them physically so they can see your face, or they're going to have your fingerprint. That's a lot harder than just forging your signature. And if we're really talking about digital money, your money is going to know where you are, because your money is going to be linked with you in some way. Maybe it's going to be attached to your phone, or maybe it's going to be attached to you personally. I mean, this is the future. And so if your money notices that you are spending money 100 miles away from where you are physically located, it will notify you. Hey, somebody's trying to spend your money. Even though it might be significantly harder to hack, it will still let you know, hey, you are not here and somebody's trying to spend this money. Is this you, or what's going on? And then you can deny it right there. And companies right now are working to increase this level of security through more technology. Like some companies are working to identify you through your heartbeat patterns and through your breathing patterns. And these are things that are even more difficult to copy and mock. And so for somebody now to use your money is going to be extremely difficult, because you are unique in your heart regulations and your breathing patterns. And if it knows where you're located, people will not be able to steal your money the way they can right now with your cash or your debit card or your checks. So when we're talking about the future of money, carrying physical money, whether it's in the form of cash or cards, is going to be old historical news, and your grandkids are going to ask you what it was like to carry money with you and carry credit cards with you, because that's something that the future generations are never going to have to do. You're already seeing credit card companies start to adapt to this, because you're already seeing things like Apple Pay, but also you're seeing merchants that if there is a potentially fraudulent transaction, credit card companies will give you a one-time code or a verification code or a merchant code where you have to put in this number. That way you can verify that you're making this transaction. This is not something that happens through a physical card. This is something that happens through technology digitally. Does this mean that it's going to be impossible for someone to hack your digital money? No, hackers are going to get smarter too, and this is where you're going to see advancements with technology on both sides. Like you're going to see physical wallets, where now you're already seeing there's a cryptocurrency where you can take your money and pull it out of the internet by putting it into a physical wallet, and now you can store this somewhere safe. That way, if you want to protect yourself more or your wallet more in the cloud, you can move it away from the cloud into something physical. But let's also talk about the convenience of digital money, because this is also going to be a driving factor for digital money over the next decade. So I live in the United States, and I had to hire some vendors from Canada, and because of the pandemic, they were not able to do the work, so they had to send me the money back. And this was such a difficult transaction, because first, we deal with the US dollar in the United States, and in Canada, they deal with the Canadian dollar. And so it's not a one-to-one dollar. The United States has a stronger dollar than the Canadian dollar, and this fluctuates with time. Now, for me to send this money to Canada, there's a few ways for me to do that. I wired the money to them. So I had to go to my bank, I had to talk to my bank teller, I had to sign a piece of paper, I had to sit there for like half an hour, and I had to pay like $20 or $30 or something like that to get my money wired from my bank account to Canada. Now, they had this money for a little while, they couldn't do the services, and so they had to give me the money back. they had issues trying to wire this money back to me. And so we had to now go through PayPal to get this money back, and PayPal held the money for a certain amount of time because they were trying to verify to make sure that there was no fraudulent transactions going on here. And so it was a huge mess. I had to pay a lot of fees to transfer my money there. I lost more money on fees when the money came back here, and it took forever for this money to get transferred. And that doesn't even change the fact that the amount of money I gave was different than the amount of money that I got because our currencies changed over the last few months. This is what cryptocurrency is trying to change, because cryptocurrency is trying to create a decentralized worldwide digital currency where now you have a currency that can go across all borders, so you don't got to worry about conversion rates, and it's super easy to transfer. Because if I want to transfer some cryptocurrency to you, I can just get your address, send it to you, and you can send it back to me if you ever wanted to. When you do that, now you don't have to deal with so many big financial institutions. You can deal with individual people, and you can transfer money from people to people instead of going through a bank and having this bank work with other institutions and having to go through all of this and have all of your information disclosed through there. You can work directly with a person, find their address, and just send it to them. The thing that makes cryptocurrency so interesting is the user ability to use and promote cryptocurrency. Because let's talk about Facebook for a minute. Back when I was in high school, I remember Facebook was just starting to become popular. And I remember I was on the football team, and some of the guys were talking about this Facebook thing. It might have been MySpace, but I think it was Facebook. But they were talking about this Facebook thing. And they were like, hey, have you heard of this Facebook thing? You should get on Facebook. And so they were recommending Facebook to their other friends. And when you recommend Facebook to another friend, what do you get? Well, now you have another friend on Facebook, right? And so when people recommend social apps like Facebook and Instagram and TikTok, what you're doing is you're promoting these apps and you have more networks within the app. With cryptocurrency, it's a little bit different, because now when someone uses Bitcoin or Ethereum or whatever cryptocurrency you want to talk about and they like it, then what you can do is you can tell your friends, hey, have you bought Bitcoin? Hey, have you started using Ethereum? Now, when your friends come onto cryptocurrency, what are you doing? You're having other users come into cryptocurrency, but you also have other buyers coming into this cryptocurrency. And when you have other buyers coming into cryptocurrency, you're effectively making more money because now your currency becomes more valuable because you have more people that want to buy it. Remember supply and demand? When you have more buyers and sellers, the price of this asset goes up. And so cryptocurrency creates this natural affiliate system where people are going to want to promote it and recommend it to their friends, because when somebody owns a cryptocurrency and they recommend their friends to use it, their friends will come onto it. Now they'll want to buy it too, and that will naturally push the price of the cryptocurrency up. So you get paid to refer your friends to this cryptocurrency, because when more friends come onto it, more people buy it, and now the price of your asset goes up. So you're the one making money by promoting it. With Facebook, you weren't making money, you were making Facebook money. With cryptocurrency, when you own it and you tell your friends to own it, now you're making money because you have more buyers coming into the cryptocurrency. This is where you're probably going to start to see a lot of different communities and cryptocurrencies created around different communities, because you're going to see influencers create their own cryptocurrency, and then they would give this cryptocurrency or sell it to their audience, and then their audience, if they want to support this influencer, is now going to want to buy in, and they're going to want to recommend their friends. Not only does it help the influencer, but it also helps this cryptocurrency become more valuable because more people are going to want to come in. So you created this natural affiliate network, because when people are using your cryptocurrency and they like it, they're going to want to tell their friends, because not only do they like this thing, they like the influencer, but they want to make more money, because if more people buy in, the value of this cryptocurrency goes up. And so you're going to see a lot of different communities tokenize what they do by creating cryptocurrencies around their community. The value of that is you'll be able to use these currencies as actual cash, because now you might be able to buy products, classes, or clothing, or access to certain events through this cryptocurrency. And if you have a certain amount of cryptocurrency, you might get bigger discounts. And so now you're building this kind of natural affiliate network where not only are you going to want to promote this to your friends, but you're going to make more money, which will allow you to buy more things from this person or this influencer or this community, because this cryptocurrency has allowed you to do that. Pretty much everybody who was born after the year 2000 learned to type before they learned to write. This is the digital generation. All they know is how things work behind a computer screen and a phone screen. Now, you can hate this or you can understand what's going on, right? The next generation is completely digital, and so they live their lives digitally. When I was young, when I wanted to be cool, I would go to the store and I would buy Dragon Ball Z cards. Some people bought Pokemon cards. I was a fan of Dragon Ball Z, so I would buy these cards. The value of these Dragon Ball Z cards were, whatever you would make of it. If I got a really cool card, it would be very valuable to me, and somebody else who's also a fan of Dragon Ball Z cards would probably be willing to pay me a lot of money for that card. right? And so it's the value that somebody has in it, somebody believes in it. And I used to love Dragon Ball Z cards. But the next generation is a little bit different because the next generation does everything online. And so what they find valuable is things that are digital. You're already seeing this happen. You have games like Fortnite, which is a free game, which is making billions of dollars a year because people are able to make in-app purchases. They're able to customize their character. They're able to buy special clothes and special hairdos and special weapons, which make you look cool in the digital world, but they don't do anything in the real world. But people love the digital world and they want to show off what's going on in the digital world to their other friends digitally. And so people are already spending their real money in the real world and the digital world to impress their friends digitally. And so now this is going to happen in the money world too. And so what do you think is stopping that from happening in the cryptocurrency and blockchain world too? You might have heard of NFTs, non-fungible tokens. The whole idea is this is a digital piece of art that somebody can buy. They became very popular when somebody paid like $67 million for an NFT, a piece of art that you can only see digitally, that this is something that you own digitally just so you can show it off to your digital friends. Sorry, it wasn't 67 million, it was $69 million. Now at this point you might be thinking, who in the world would want to buy digital art? You can't show it off in your room, you can't show it off to your friends in your house. Why would people want digital art? Well, because now people are hanging out digitally. And so people want to show off what they have digitally. That is the future. Sure, maybe $69 million for a piece of digital art might seem excessive, but you got to understand the kind of technology and the theory behind this. Because if the next generation does everything online and they hang out with their friends online, because when my young cousins get together, they sit in a room and they play video games together on their own phones. They're not talking to each other here, they're talking to each other through a screen, even when they're hanging out in person. The next generation hangs out with each other digitally. Now, this is good, this is bad, that's irrelevant. In this case, we're talking about what the future is. The next generation does everything online. So when we're talking about having this luxury and having something to show off and having your kind of pieces of coolness, people are going to want it to be digitally. And this blockchain is what is going to power that to happen. Blockchain is what cryptocurrency is built off of. And this is the thing that allows you to transfer and store data and allows you to protect everything. And so blockchain is just its own technology that allows you to do a lot of things like send money, and create this digital art, because it allows you to create something that you own, like money or art. And the thing that makes blockchain and cryptocurrency so interesting is kind of the creativity and the number of opportunities that you have with it. For example, student loans are a major issue right now. If you want to go to college and you don't have a ton of money or you don't have rich parents, you're going to have to go into debt to have money to go to college. Well, blockchain can change that. Because what blockchain can do is it can tokenize your personal earnings. And now what you can say is, yeah, I'll come to your university and instead of me going into debt to go fund my college degree, what I'll do is I'll tokenize my earnings and I will give you, the university, 1% of my future earnings. Now what you're doing is you're incentivizing the university to actually make you money, because now the more money you make, the more money the university makes, but you also don't have to go into all this debt to fund this degree. You're just going to pay them a piece of whatever you earn. So you can tokenize yourself, you can tokenize your earnings, and you can distribute it, like for your college degree, you can give them 1% or something like that, where now you don't have to worry about trying to find the money to do this. You can tokenize your future earnings. Now this is where I want you to be a little bit cautious, because the last thing I want you to do is think, oh, cryptocurrency is the future. So you take all of your cash and you just go dump it into cryptocurrency because you're hoping that it's going to be the reason why you get rich quick. There's more to it than that. Cryptocurrency and blockchain have the ability to completely disrupt the way we do money. That is a fact. Now, there's a lot of uncertainty between now and when that actually happens. And so you have a lot of people that are buying up cryptocurrency, speculating, hoping to make quick profits, because you have a lot of people that are buying Bitcoin and Ethereum and Dogecoin because they just want to make a quick buck. You're finding these cryptocurrencies, you're buying them, you're selling them, you're buying them, you're selling them. And so people are just trying to do this to make a lot of money quickly. But the application of blockchain and cryptocurrency is a little bit different. Depending on what's going on in the world and depending on what people feel about cryptocurrency, you can see wild swings in the cryptocurrency market, because people are looking at cryptocurrency as a way to get rich quick. I mean, this is the reality. People are looking at cryptocurrency as something that can never come down, and so people are leveraging up their bets, hoping to make a lot of money quickly. Now, this is creating a lot of volatility in the cryptocurrency market, and yes, you could see a cryptocurrency crash if people stop buying in, but there's still a lot of underlying value and potential in the future with blockchain, and that's what I want you to pay attention to, because you have a lot of traders right now just trying to get rich quick with cryptocurrency. But what I'm talking about is the long-term potential of cryptocurrency and blockchain, because blockchain can change a lot more than just the way you go shopping on Amazon. This is one of those things where we're going through a massive transition period right now, and we're going to see a lot of roadblocks. You're going to see banks oppose it. You're going to see governments oppose it. It is not going to be an easy transition, because anytime you see change, you're going to see opposition. But there is a lot of potential to change the way that we do things, money, and transactions through cryptocurrency and blockchain. And so you want to understand what's going on. That way you can be on the cutting edge and be on the winning side of things, instead of just being the person that is reacting and being on the losing side of things. Does that mean that you're going to see crypto prices shoot up like this? No. Absolutely not. It is a very volatile investment because you have a lot of traders emotionally involved. What I'm saying is you have a lot of future with cryptocurrency and blockchain. And so you got to understand what's going on, and you got to understand how this is going to change our economy. And that's where you got to make your investment decisions accordingly. I mean, just look at what happened after the 2000 and 2001 dot-com crash. Everybody prior to the year 2000 thought that the internet was the future and that you would never lose money with the internet, because everything with the word .com at the end of it was skyrocketing like this. And so everybody started buying up these .com companies, and then came the year 2000, 2001, and all of these .com companies crashed, and you saw so many .com companies go out of business. And then you had all these people come out and said, oh, the internet was just a fad. I told you the internet would never take off. And look at where we are now. And so this is where you have to be smart and understand that there's a lot of emotion in things. And yes, you could see things come down. You could also see things go up wildly like this. And so you just got to be smart and understand what is going on. That way you can make smart decisions with your money and your wealth. How does somebody now who is watching this thinking, I want to get involved in cryptocurrency, how do they find a good currency to buy or invest in? Elon Musk was a big talker of Dogecoin, and just more recently, Shiba Inu, which rallied, hundreds of percents. How do you decide what's a good way to go?
Simply, you go to how